And so, of course, the headline you all know, we talked about this quite a bit a year ago, is inflation. In June, 9.0%. That was later revised upward to 9.1%. But here's the headline that no one is talking about. And we think this one has much more meaning than the previous one. This is from January. The Dow falls 500 points on solid economic data. The Dow falls on solid economic data. Now, what's interesting is we actually believe markets are very good aggregators of information, at least on average. We believe market prices are usually important signals in the economy. This tells a very different story. This actually says that price signals have been broken. Things like stock prices, home prices, prices seem to be disconnected from economic fundamentals. And the question becomes, how do you forecast an economy under that situation? And this isn't just one headline. Since that January period, we had another one here. The stock market climbed more than 700. So after falling 500, it climbed 700. Why did it climb 700? Because wage growth slowed down. Real wages, as of the most recent inflation number, are down 2%. People's standard of living is lower than it was 1 year ago. And then this one more. U.S. economy adds 517,000 jobs. This was just a couple weeks ago, early February. Not just the economic consensus. CERF was shocked by the jobs number, 517. The consensus number was around 200,000 jobs. It came at 500,000, and what happened? Stocks promptly fell. Many price signals, many economic variables are disconnected from underlying fundamentals, and we have to make sense of that in order to understand what the outlook is and what we expect in the future. So I want to talk briefly about how do we get here, just how extraordinary is this, and then how on earth do you forecast? And what everybody wants to know these days is which is the outcome we're headed for, hard landing, soft landing, or stagflation. There was actually a period a while ago when you could have put a line through soft landing. No one was talking about soft landing, right? It was either going to be hard landing or stagflation. Now, just in the last few days, you probably heard this word. You're going to hear it much more. No landing. This is the current forecast. There's a number of major financial houses that are saying, no, it's not hard landing, it's not soft landing, it's no landing. We're off to the races. The economy's going to take off. And we're very, very skeptical of the no landing forecast. We'll talk about why, what the assumptions are leading us to that conclusion. We don't believe the economy is just going to grow itself to prosperity now under the current regime. So how did we get here? How did all this start? How did price signals get disconnected from fundamentals? Well, we talked about this last year. A lot of this starts with the monetary policy, with the Federal Reserve, with what it did in the pandemic, and maybe even more importantly, what it's been doing going back to 2008. This one, there's an infinite amount of cash in the Federal Reserve. We were reassured during the pandemic. Right? That sounds like inflationary talk to me. Now, it's not like the old days where the Fed prints money. What the Fed does now, very simply, is it calls one of its primary dealers in New York. It says, hey, look in your electronic account at the Fed. We just moved the decimal point, right? You have more money in there. Go ahead and acquire assets. That translated into a balance sheet held by the Fed of $9 trillion. You can see that is a doubling of the balance sheet from that period between 2014 and 2018, right, which was still the response and the fallout from the financial crisis and the Great Recession. This is an unprecedented amount of money of assets held by the Federal Reserve. And of course, this creates money. This is money creation. When it goes into the account of a primary dealer, it goes out into the economy. And so what we see here is the money supply grew more than 40% during the pandemic. We have had 9% was the peak inflation rate. We actually thought that was sort of a low end of our estimates. It could have gone higher when you look at 40%. Now what's interesting, as Ms. Strassel mentioned, is that we're now in this period where the money supply has started to shrink again. And so we are sympathetic to what's called the quantity theory, that when the money supply increases, more money chasing fewer goods must drive prices up. And so that begs the question, well, does that mean now that it's shrinking, that we're going to see deflation, that we have to worry about this? Well, the interesting thing is it's only down 3% from the peak there in April 18th. So it's hard for us to believe that this is a deflationary cycle. The other one that we need to understand is that a lot of this, these monetary interventions they don't affect outcomes necessarily immediately. You may have heard journalists talk about long and uncertain lags in monetary policy. We don't believe there's long as many other forecasters do. We believe they're shorter than the consensus. But we believe that we still haven't felt the entire impact of that 40% increase in the money supply. So that's to say, we're predicting an inflation that is more persistent, longer lasting, and maybe permanently higher than many of the other forecasting houses are right now. So how did we get here? So that there's money creation. There's also, in this case, a powerful fiscal channel, unprecedented, right? We're talking about unprecedented political moves, broken norms, right? This was a true economic norm that was broken. When Powell went to Washington, they actually expanded the Fed's balance sheet even before the legislature was able to step in and pass the various relief programs in 2020 and said, Congress needs to spend more. And so that created a fiscal channel, right? A lot of this money creation went right in onto the bank accounts of Americans, and we see this most in excess savings. So the savings rate went from about 5% to over 30% during the pandemic. That is to say that all of the relief packages, when added up, were much greater, in fact, than all of the income that was foregone because of economic shutdowns during the pandemic. And so that is sitting, and you see here today that the yellow values are history, and we have a pretty aggressive forecast of the decline in excess savings. A lot of this is still sitting on individual household balance sheets. And again, that means that there will be continued pressure on prices even as the Fed continues or not along the current hiking cycle. So breaking economic norms. Underneath this are a series of extraordinary policies that were undertaken by the Fed in 2008. Really, all of this goes back to 2008 when they entered into zero interest rate policy for the first time, pushing the short-term target rate to zero. They engaged in quantitative easing, whereby the Fed was buying treasuries and mortgage-backed securities, long maturity treasuries for the first time in its history, and then paying interest on reserves, paying banks to hold on to money and to park it at the central bank. So these are extraordinary. Now, in terms of understanding just how extraordinary this is, I want to draw your attention to Jim Grant, monetary economist. This is the charitable view. He said, well, you don't watch the house burn down if you're a firefighter, even if you're the arsonist, right? And so the Fed had to do something. Even if it played a role in inflating housing prices, it had to step in and do something in response to the financial crisis and Great Recession in 2008. We referred to it a little less charitably over the years from 2017, 2018, 2019. We've referred to it as a dizzying policy experiment, and we've anticipated that many of these unprecedented interventions would be impossible to unwind. And we believe there's evidence that that's proving true. Now, even in terms of the Fed's own analysis of what it was doing, their own research was a little discouraging. This is not a typo. When the Fed planned to undertake quantitative easing, their own research said, well, a $600 billion increase in quantitative easing only reduces unemployment by 0.03%. The Fed itself wasn't all that bullish on what it's doing, and you need to know that there was quite a bit of controversy within the Fed at the time. Dallas, Kansas City, Philadelphia, Richmond Fed presidents were opposed to what the Fed was contemplating because this was poorly understood and might prove impossible to unwind. Some of the comments: Kansas City Fed President, QE will be the equivalent of a military quagmire. Plosser in Philadelphia, I think it would be a mistake to convey to the public that we know what we're doing, right? In fact, we don't. And then Fisher, I see considerable risks in conducting policy with the consequence of transferring income from the poor to the rich. You also should know that the New York Fed has actually done some research demonstrating that a lot of these policy interventions undertaken in 2008 expanded income inequality substantially, income and wealth inequality. It had a differential impact on minorities, racial and ethnic minorities, on disadvantaged communities, right? That there is evidence that these policies resulted in a transfer from the poor to the rich. And then Jerome Powell, right, who's at the helm now, actually said himself in 2012, QE is habit forming. QE will inflate a duration bubble. A duration bubble is a little bit of a wonky term. Duration bubble actually means that it's the riskiest assets that will see the greatest increase in their prices, and that's certainly what we see, especially as the duration bubble started to unwind in 2022 as tech stocks saw larger declines than any other part of the stock market. So this is what a bubble looks like. These were bubble prices back in 2018 and 2019. We know that because on October 3rd, Powell announced he was going to unwind QE, start to sell off the balance sheet, and the S&P dropped 19.7% in a matter of days. Right? When he announced on January 4th, I didn't mean it. I take it back. The bubble reinflated. And this is incredible. From the January 4th low to the start of the pandemic, the S&P 500 was up 40%. From January 4th, 2019, to the peak last year, the S&P 500 was up 104%, right? And so this is an asset bubble. And we see evidence, and you see it here. Now we have this sort of charming, down here on the left-hand side, we see this very large decline that we saw in 2019 looks tiny and quaint, right, over there on the left now, compared to the extraordinary asset inflation that we saw. So this leads us back to the question of the moment. So how do you forecast the economy during conditions like this? Well, we think about it first as well as the Fed actually fighting inflation. Whether we're headed towards hard landing, soft landing, stagflation, you have to answer this question. And unfortunately, that means that the forecast hinges on predicting the behavior of human beings at the Federal Reserve, all right? And so that's why it's a low confidence forecast. But we have to answer the question, is the Fed actually fighting inflation? Well, this is what the 10-year Treasury looks, the real 10-year Treasury. Take the yield on the 10-year, subtract inflation, and it's not only negative, it's very, very negative. The last time the Fed fought a serious bout of inflation, that's in the blue circle what real 10-year Treasury yields look like. So we are not persuaded that the rate hiking that the Fed is already undertaking is aggressive, as it's been described, is rapid or unprecedented, right? We actually believe that not only were they behind the curve, that they are still very likely behind the curve today, which means we would predict higher inflation in the medium to short term. Now, there are some rules, and the rules aren't perfect, but the most famous one is Taylor rule. This is a way, if the Fed were to implement a rules-based monetary policy, it would be how the Fed would set the target policy rate, which today is 4.5 to 4.75. The Fed's predicting it may move it to 5 or even to 5.25 in the next year. The Taylor rule says that today, depending on which inflation measure you use, the target rate should be between 7.5 and 10.8. There is no forecast, the Fed's or otherwise, where the Fed is anticipating moving short-term rates that high. Now, that doesn't mean that inflation is going to stay at 6.5%. It could still come down because they have started hiking, but we are very, very likely to have well above target inflation, declining real wages for some time to come. Now, you might ask, well, how can they be so far behind the curve? How can it be? Well, because this is the consensus forecast that they're looking at. Do you notice that the forecast never gets updated? So what you see here is this is the history of how inflation proceeded, and then the red line is the forecast of what inflation would do next at each of those points in time. The forecast never updated to internalize new information. No matter how high it went, it's turning around tomorrow, it's turning around tomorrow, right? And so this is this notion that the causes were not monetary and fiscal, that the causes were these outside shocks that the pandemic induced to the supply chain. There's plenty of evidence now that while that may have been a factor, monetary and fiscal policy is a primary driver. And we've said this is a quote actually from years before the pandemic. Financial markets completely dominate U.S. monetary policy. And that's to say we believe that the best prediction of what the Fed will do is what they've done in the past. And that's to say they won't aggressively fight inflation. They're going to let it run well above target. They're going to allow erosions in real wages for a time to come. And that means they're not, if that's true, they will not tip the U.S. economy into recession. So you can just strike hard landing off the list, right? They're also not going to achieve a soft landing under that forecast. Now, you don't have to take our word for it. This is exactly what markets are predicting as well. And so you see here, the median 1 year ahead inflation expectations, 5%. Markets believe inflation rate will still be 5% 12 months from now. And the 3 years from now, it will still be 3%. That's 50% above the Fed's target. And markets are also predicting actually the Fed may start decreasing rates by the middle of this year, right? Which is, again, means they would just be reinflating the bubble. They'll call that no landing, but what that will really mean is simply reinflating the bubble and setting us up for the next financial crisis, when they won't just have to go from $4.5 to $9 trillion, right? The sky will have to be the limit in order to maintain economic activity under that scenario. So we're forecasting real 10-year Treasury yields negative for the entire forecast horizon and fairly large in scale. We're also predicting slow growth. So this is a no recession, stagflation forecast, which means chronically low growth, inflation well above target. And unfortunately, that means less economic mobility. It actually means greater inequalities of the brand that we saw in the decade following the financial crisis. It may mean new social unrest, growing social unrest. And so in that sense, it would be very unfortunate. I show you here the Wall Street Journal consensus as a comparison. You see we're well above that. That's a little bit misleading because about half the forecasters in the Wall Street Journal survey are predicting recession. Half of them are not. So this is an average, which means it doesn't really tell you, well, what do the recession people think and what do the non-recession people think? So we can show you. So here on the left, or in the middle column rather, you see what the recession forecasters are predicting among the 77 in the Wall Street Journal. Minus 1.1, minus 1.3. So they're predicting a fairly weak recession, not a big, painful recession. Over here on the right-hand side, you see the expand crowd. The folks that are predicting no recession, positive 1.1, 1.0. And then you see CERF over here on the left, 1.9, 1.7, 1.5. So this should settle it in this room from here on out. We should be known as the sunny, optimistic forecasters from this day forward. We're even optimistic relative to the other optimists in the economy. All right, and so the long-run forecast is 1.4%. This is actually unchanged from a year ago when we were in this room. I always like to show that top line, 1947 to 2007. The long-term, sweet spot of economic growth in the United States is 3.5%. Right? That persisted on average for decades. That is a rate at which the economy doubles in size every generation, where our children can expect to have greater prosperity, higher standard of living than we do. And unfortunately, we've been well below that since 2008. You see, just 1.9% in the decade following the financial crisis. And this is even weak compared to that decade. So there's real work to be done unwinding the extraordinary interventions in monetary policy. Unfortunately, we don't see that happening within the forecast horizon.